Hi, it's Griggs with Obsidian Wisdom. The fourth and final way for you to diversify your retirement income streams is to take taxes into consideration. Most people do not look at their taxes, and as you often hear me say, that is the silent killer of a lot of people's retirement plans. Your Social Security is taxed, your 401k, 403bs, your normal income, all these things are taxed in retirement. And depending on the overall brackets that you're in, I will put a link to another video where I go through some of those retirement strategies, but you really should take taxes into consideration when it comes to your retirement income. And the way I often look at it for people is you want to have a portion of your retirement income in pre-tax and a portion of your retirement income in after-tax. And the big difference is pre-tax is money that hasn't been taxed yet. And because it hasn't been taxed yet, like your 401k, your IRS, and things like that, that means that when you go into retirement, it's going to be taxed as your normal retirement income. And depending on how much money you have coming in, that could be 20, 30%, right? It could be a lower amount, but it easily could be 20 to 30%. If you weren't taking that in consideration, you may not actually have enough money saved for your retirement. But if we have all of our money inside of our 401k, that means all of our money is going to be taxed. That also means we may have less control on how to withdraw the money because of this thing called required minimum distributions, which just means at 73, there's a certain amount of money and there's a calculation on how to do it of how much you have to take out each year because Uncle Sam wants to start getting his tax revenue. Well, the amount of money that you may be required to withdraw might put you in a different tax bracket and increase your overall taxes. These are all things to consider. Also, when you look at the way the United States and the debt is going, where it seems that every single month now you're reading about them having to extend the debt limit, where you're sitting there saying, well, how much debt are we taking on? Where it used to be something that happened once a year or once every few years, and now it's something that seems to happen once every month. And it just seems to be increasing where we have about $34 trillion in debt, which means that there may be a point in time where the government will say, we got to increase taxes. Well, that obviously won't be fun for anyone who has deferred taxes in their pre-tax investment, like their 401k and their IRAs. And now they're going to pay taxes in the current environment where the money is being taxed at a higher rate. Now, granted, we don't know what will happen to the tax structure, but what we do know is that we have $34 trillion in debt and growing. And we're at historically low taxes right now. If you were someone who was working in the 1980s when the 401k was invented, you could have been taxing upwards of 90% of your income. Where if you made $100,000 a year, you would have probably paid somewhere around like a 59% tax bracket. Versus if you were to do $100,000 a year in this current environment, you may only pay 22%. So that strategy made a lot of sense when taxes were at historical highs versus where taxes are today at historical lows. It's just something that you want to keep in mind. Also, where your assets are can impact the withdrawal strategy that makes the most sense for you. Depending on where your assets are, it may make sense for you to access your pre-tax money first, and then your tax money second, and then your tax-free money third. So when we talk about taxed money, that's going to be money that's just invested in the normal stock market. It could be money from your real estate. It could be money from your business and your profits. That is just going to be taxed income. That's your normal income sources. And then your tax-free income is normally going to be your Roth or your Roth conversions, where you've already paid taxes on the money and Uncle Sam is allowing it to grow at a tax-free rate, and then you access it at a tax-free rate, which is pretty nice. Normally for most people, accessing your tax-free money third makes the most sense. That way, when you look at your multiple income streams, I'm getting rid of my pre-tax first, because if I'm just spending that amount, then I may be in a lower tax bracket and I don't have to pay as much money. Versus if I tacked on my tax deferred, my taxed, and my tax-free money, that amount of income may put me in a different tax bracket. So I normally want to get rid of my income that's taxed second, because that's going to give me the lowest amount of income. And in the end, all I have is my tax-free money. And so that way I'm able to manage my overall taxes. Again, I go in a lot more detail, and I'll put a link to my tax considerations video for retirement. Well, that'll do it for today's video. Be on the lookout for the next video in the series. If you are someone who's planning on retiring in the next 5 years and want help feeling happy and not worried about it, don't worry, we got you. I invite you to go to obsidianwisdom.com/wealthy. I'll put a link in the show notes to learn more. Until next time, stay safe and enjoy life.